Hey guys, thanks for watching Smart Money Minds. My name is Ben, and today we're going to be talking about how to make money when the stock market comes crashing down on you. When people see red in the stock market, most people's reaction is to be fearful and to be super scared that they're going to lose their hard-earned money. However, you could be one of the few that gets excited when you see stock prices drop, because you'll be making the money. This leads us to talking about what short selling is. You might have heard of this term from documentaries like Dirty Money or movies like The Big Short, but this is where you can make money from when stock prices are dropping. Let's give you an example here. Imagine you have a friend called Joe, and Joe has an antique coin that is currently worth $20 in the market. However, you believe that Joe's coin is actually going to be worth less than $20 next week. So you decide to borrow Joe's coin, given that he's okay with that for sure, of course. Joe says, look, since you're borrowing my coin, I'm going to have to charge you interest. So $1 per week, if you're okay with that as well. So you take Joe's coin, and you guys have an agreement, and you take it and you sell it to the market. Next week comes, and Joe's coin is actually only worth $5 now. You decide to buy the coin back from the market at $5. So you've made $15 selling something that was worth more previously, and now you're buying it back for less. You give Joe back his coin, plus $1 interest, you've made $14. This is the essence of short selling. So in the stock market, instead of guys like Joe that's going to lend you their coin to sell to the market, you're going to have to look at places like your bank, your broker, your financial institute that may have some shares of a company that you may want to borrow and sell to the market. Obviously, these brokers are going to charge you interest for borrowing their stock, but they're going to also charge you a fee for buying and selling with them. So in this scenario, the same rules apply, where you're betting that the stock will drop in price so that you get to buy back at a lower price. However, if the stock price goes up, you're going to have to pay interest for borrowing that share still and also buying back at a higher price. That's a double whammy. Another drawback is that you may not be able to borrow the shares that you want to short. Not all banks or financial institutions will have the stock or allow you to borrow some of their shares. They may have most big names like Amazon or Tesla, but if you're trying to short a penny stock or not a very popular stock, they may not have that share for you to borrow. And it could be very difficult for you to find those shares to borrow. Also, all registered accounts in Canada, like the RRSP or the RESP or TFSA, they do not allow shorting. Only margin accounts are allowed to sell short, and as most people only invest with their registered accounts, the opportunities for short selling are limited. With this in mind, it's important to remember that the stock market is full of opportunities, and even though most of the opportunities is in buying a stock long, for the smaller percentage of people who are selling short, they could be extremely profitable as well. We want to look at stocks that are overpriced or are in downtrends so that we can capitalize on those opportunities to short and profit. So in the comments below, tell me if you like to sell short. Do you prefer it over buying long, or do you do a combination of both? I'd love to hear from you. And if you had no clue what the heck I was talking about selling short in this video, then make sure you catch my other video, which is Stock Market for Beginners, and that will teach you everything you need to know for beginners. And don't forget to subscribe, please like this video, and hit that notification bell, and we'll see you next time.